Good afternoon, everybody. Welcome to the webinar for today as we talk about successful strategies in 2017 and kind of what worked and some thoughts on that, and then try to encourage you for 2018 to get started the right way and get your thinking right. And so I welcome everybody today. I'm Dan Sheridan, and glad to be here. So today we're going to talk about strategies and successful trading and kind of what goes into that, and then looking ahead at 2018, and hopefully if you didn't achieve all you wanted to in 2017, maybe get a few ideas or something from today to help you be a little better next year. We're all craftsmen trying to get better at this. And you know, as I was thinking about this, you know, when you think about, you know, I was at the CBOE trading for maybe 22, 23 years before I got into mentoring 14 years ago. You know, when you hear successful strategies, it does give the impression that there's some magic in a strategy, doesn't there? Like if I asked you guys, what was a successful strategy for you for 2017? What would you say, right? I mean, just a general term, butterfly, credit spread. What worked for you in 2017? What worked for you in 2017? If you want to, if any of you had a strategy that worked for you, just name the general trend of it. Calendar, butterfly, double calendar, broken wing butterfly, iron condor, credit spread, many different things. And, you know, two things to pop out in your mind, right? You know, ultimately, you know, at Sheridan Mentoring, what do we try to help people become good craftsmen, right? Did they really learn this stuff? Very similar to how I learned when I was at the CBOE. But as you look at strategies for 2017, here's my first question to you. Does a successful strategy mean that you know what you're doing? Yes or no? If you had a strategy on for 2017, and it was a successful strategy, does that mean that you know what you're doing? Yes or no? What do you think? Well, I think there's some yes and no, right? I got to give you credit if, you know, for example, let me ask you a question. If you put on a steady dose of put credit spreads or covered rights or cash secured puts over 2017, in general, would those strategies have worked out real well? Yes or no? If you did cash secured puts, which are just, you know, selling a naked put, any type of a covered right, really, I mean, I'll add more strategies to that, but the answer is yes. So, I mean, if I went to Chipotle, right? If I went to Chipotle burritos or whatever, Chipotle last year, 13 months ago, and said for 2017, I want you to put this thing on. I'm not even going to tell you what it is. We're not going to talk about options. Just put this type of put credit spread on. Right? Every week or month, would they be successful? Probably. Why? Because the market's gone up. So I think we have to distinguish between successful strategies because the market's gone up for 2-3 years. So anything that is a little more bullish was going to have a hard time losing, agree? But ultimately what we want to get, and I think it's important, successful strategies and talking about it, but what I'm really getting at more than anything is that you become a good craftsman, right? That you actually know what you're doing, right? Anybody doing put credit spreads in SPX or RUT over the last year, whether you're 100 points out of the money, 200, it doesn't matter. You should have done well last year. Why should you have done well? Because the stinking market went up, right? And up and up and up, right? Period, right? And so, but ultimately, you know, if we take everybody who did put credit spreads, what will happen if the market goes down? You have to know what you're doing. All right. Anyways, so I'm just going to go over today a few strategies that worked well in Sheridan Mentoring, but let me preface this. Do I think it matters for a lot of income strategies what strategy you do for 2018? Out of the ones we teach and stuff, I don't think it matters. What matters is you learn how to trade, right? Now, does it help to have a strategy with no risk in a particular direction, like a put credit spread and covered right? Yeah, and I think having one of your 2 or 3 trades like that, I think is helpful. But I think ultimately the long-term success, agree? The long-term success of you as a trader can't just be on, I'm really not sure what I'm doing, but I'm doing put credit spreads and the market's going up. Most of you would agree, right? Unless you've drinking a lot of Kool-Aid today, most of you would agree at some point in your lifetime, the market will go down and test these put credit spreads. Would you agree? How many have not drinking enough Kool-Aid that they still believe sometime in your lifetime we'll have another 7 or 8% correction? All right? I'll answer for all of you. We will, right? And so you ultimately have to learn how to trade. All right, so let's go through a few strategies here. Successful strategies for 2017. Ultimately, any of these strategies would be successful if you have the right person driving the controls of it, right? Butterflies, calendars, put credit spreads, covered rights, cash secured puts, long diagonals, which are like covered rights without stock. Now, what we could say is, could you have been successful in iron condors over 2017? Yes or no? Could you be successful in iron condors over 2017? And what's an iron condor? An iron condor is an out-of-the-money call credit spread and put credit spread. Do you think you could have been successful in iron condors over 2017? Yes or no? Of course. Yeah, of course. Charles says no, but Charles, the answer is yes. Right? You can't. You could, right? But it depends on how you trade them and risk management. But the bottom line is, with the market going straight up, were put credit spreads easier to manage than iron condors? Yeah. Does it mean put credit spread traders made more than iron condor traders? It doesn't mean that. It just means that put credit spread traders had more time to use the remote control and eat potato chips because the market just went up, right? So there's a distinction between something that's easier to manage because the market's going up, right? All right, so I'm just going to go over 3 strategies today. I'm going to talk about 3 strategies that were used pretty often in our community and just talk, right? Because a lot of you some of you may, you have different views on income trading or making money in options. And so this is just a talk. All right, so let's dig in. So here's a price chart of SPX as of today, correct? This is a price chart of SPX as of today. And as we can see, it's a pretty clear picture, right? Pretty clear picture. A few little bumps to the downside, agree? Nothing major, but for the most part, it's been a pretty good move up, right? And as we look at, even since August, in the last 3 months, what's that song? Up, up and away. Da, 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 da. Remember that song? In the last 3 months, we've gone up almost let's say 200 points. 200 points divided by 2450. We're up 8% in the last, is that right? We're about 7 or 8% up in 3 months. Did I do that right? Since the middle of August, so we're talking about 3 months, we've gone from about the 2450 level near the 2650. That's about 7%. Do you agree? Yes? Did I do that right? For 3 months, we're up about 7%. And, if we look over the last 1,000 years in the market, how many 3-month periods in the S&P were we up 7%, right? So, do I think this is an outlier, an exception? I don't know. The good thing is, the longer you're in the market, the more you realize you don't know anything. And so I don't trade that way. I don't trade. I mean, I have opinions like you guys do, but I couldn't rely on my opinions for successful strategies or to make money, right? I don't know where the market's going, especially on a short-term basis. So the bottom line is, for most of the year, we're just trending up. And I think for the first 2/3 of the year, this was in a lot of ways easier. This was easier trading. Why do you think this was probably easier making money than this period? Why do you think? It comes down to one word. Why do you think that this was just for income trading? I'm not talking about directional stuff, non-directional stuff. Why do you think this period, the first 2/3 of the year, was much easier than the last 3 months? Anybody? Yeah, I mean, volatility, yeah, a little bit, but one word. One word. It begins with an S. One word begins with an S. S. Speed. This period. Okay, yeah, I got you. Yeah, this period was more stable. And this period was, bottom line is this: when you have a period like this that moves over a standard deviation or more during a time period, it's going to be more challenging for range bound trades, right? So it's not that people didn't make money during this period, but it was definitely more challenges during this period than this. Now, some strategies did well during this period, and we'll talk about that a little bit, right? But, you had a big stinking move up, and during this period of time, the VIX was like 9 or 10, most of it, right? So some types of strategies were challenged. Agree? All right. What also we've had over the last year, we've had a very low volatility environment. VIX at 9s or 10s. I don't know if I've ever seen VIX in the 9s or 10s. It seems like it was there a long time. And very seldom did we pop over 13, right? If we look at 13 here, just little spikes for a little bit of time, but most of the activity, if you look at it, most of the year was in here, right? I mean, you had some, a little bit here, more 12, 13 towards the beginning of the year, but, it's been, that slow grinding up, right? Now, so I'm just going to talk about a few different strategies, a few different durations, and just talk shop, right? And my desire for you guys is that you just, in 2018, you become more of a craftsman, right? It doesn't mean that you necessarily have to change everything you've done, but maybe try a couple different strategies and also learn the craft better. All right, so here's one strategy And again, I'm taking different durations. So I'm not just going towards short term. I'm going to go to some long term because we do both. We do short term trades, which I would consider trades that have expirations 15 days and under. And then we have trades that we do durations 30 to upwards of 60 days. You might say, Dan, is it better to do shorter term trades 15 days and under, or is it better to do 30 to 60 day trades? The answer is neither is better, right? Even if someone tells you one is better than the other, tell them they're wrong. Tell them Dan said they're wrong, because they're not right, right? There's pluses and minuses, right? That's all it is. And then you as a human being, a citizen of the United States of America, can make a decision, right? What's the advantages of doing shorter term trades? What's the advantage of doing shorter term trades as defined trades with 7 days expiration, 10 days expiration, 15 days expiration, 4 days? What's the advantages of shorter term trades? Quicker results, faster time decay, you make more money, higher yield, potentially. Out of all those, you know what to me is the most important? I didn't mention it yet. You're in the trades less, right? And I still don't think most people who trade longer term trades understand that. I don't. I'm convinced they don't understand it. That being in a trade 2 days out of a week is a huge plus versus doing 60-day trades and being in the trade all the time. Those are some of the pluses, right? And what are some of the pluses of being in trades 30 to 60 days? What are some of the pluses of being in trades 30 to 60-day duration? Yeah, more forgiving, as John said. What else? Wider break evens. Yes, you have wider break evens, but again, what could offset is that the stock obviously can move more if it's longer duration. Steve says more time to manage, easier to adjust. Let me ask you a question. What trades do you think are better for beginners to trade? Do you think it's better for beginners to trade 40, 50, 60-day trades when they start? Or is it better for beginners to trade 7 to 14-day trades? What do you think? Some of you say longer term. John says shorter term with simple rules. I mean, again, in a court of law, could you make a case for both? I don't know if there's any attorneys here, but in a court of law, could you make a case for both? Right? If I was in a court of law, what argument would I make if I was in a court of law and we had 100 new traders, what would be, all right, we have two lawyers there, right? Lawyer one is the long term. He's trying to make his case that it's better for a new trader to trade longer term durations, 30 to 60 days or more. And then you have the short term lawyer saying 7 to 14 day trades are better. So let's start with lawyer long term. In the court of law, is you're trying to convince newer traders to trade longer term. What's your argument? Your argument is going to be what? So less chance of getting in trouble, more time to react, right? For the making a case for new traders for longer term durations, maybe you'd get in trouble less, and all that. As Alan says, more margin keeps you from committing too much, less gamma. Yeah, and so maybe like a protection. But as somebody who teaches people for a living, what do I do? Do I take a new trader and do I tell, because I have this dilemma, right? When I get a new student and I have to help him make a plan. And when we make the plan, which might consist of 3 or 4 trades every week that he's going to put on different durations. But what do I do and why? Here's my answer. I tell them, look, there's pluses and minuses of longer term trades and shorter term trades. And what I tell new people is, look, I like to give them a little of both. Why? For learning, being in shorter term trades, you're going to learn a lot more. Why? Because you're able to if you put like a 10 or 15 day trade on, you're able to get it off every week. So you're able to learn more. You're able to do more trades, maybe 4 trades instead of 1, right? If I'm in a 50-day trade, I might be in the trade for 35 days. So in terms of learning, you're learning at the pace of a Russian snail, right? If there is such a thing as a Russian snail. I just made that up, or an Irish snail or whatever. But the point is, if I'm in shorter term trades, I'm going to learn more about the market. I'm going to learn, and if you give a new student some simple guidelines, not 17 adjustments. I limit adjustments with short-term trades to 1 adjustment. But you can give a new student, say, no adjustments, right? And you're just doing this trade every week. Every week you put on a trade, maybe every Tuesday you put a butterfly or something. So the advantage is you're learning. You're really learning the dynamics of the Greeks and stuff. It's nice to put a new student, I'll put them in maybe 2 short-term trades and 2 long-term because you need to contrast them. You need to see the pluses and minuses in action. Instead of telling somebody, let them see for themselves. Agree? Let them see for themselves. Let them have on 2 shorter term and 2 farther term, and they're going to learn a lot. Or you can have just 1 of each. But I think that balance, what I've seen is that works really well, right? As long as you keep, obviously you need to keep rules simple with new traders anyways. So that's what I kind of look at. And yes, Ed says, a question says, what are you thinking about the SPX 2 or 3 day expiration? Are you using them as short term? Yeah, short term trades are anything 15 days and under. So if you do a 1-day trade, is that short term? Yes. If you do a 3-day trade, is that short term? Yes. If you do a 7-day trade, is that short term? Yes. If you do a 15-day trade, yes. So, all right. So with that being said, now, let me just say one other preemptive statement, and then we'll jump into some strategies. So perspective. Do I teach students with different durations? Yeah. Do I teach them different strategies? Yes. Do I try to teach them to be a complete ball player? Yeah. Now, as a general guideline, if I have a student trading $100,000 or $10,000, what mix or allocation might I mention to them? I might mention, as a general guideline, maybe 70% of your capital in durations 30 to 60 days, and 30% of your durations, maybe 15 days and under. And that can vary. For example, it also depends on what strategy you're doing. If you're doing a short Vega trade like a credit spread or iron condor or butterfly, I've definitely narrowed my duration on trades and what I've been teaching over the last 4 months because we've been VIX are 9 or 10. So durations coming in, we've been doing less iron condors, more iron condor alternatives, as I'll talk about. So, there needs to be a tweaking of things. And Rick just mentioned that anything less than 10 days, he'll use the futures counterparts to the SPX, FRED, and NDX. That way I don't have to worry about problems with day trading. And that's an interesting point. I think the day trading, I think there's a day trading rule that says you can't do more than 3 trades. If your account is less than $25,000, you can't do 3 trades in and out in a week, right? Is that basically what it says? If your account's under 25 grand, you can't do more than 3 trades in and out within a week. I think that's basically what. But, you know, on the most part, let me just give you my thoughts on that. We don't have, 3 in and out in 4 consecutive days. Thanks, Don. So getting in and out of 3 trades in 4 consecutive days. Do we run into a problem with that with students? No, we don't have, you know, because most students are doing maybe 1 or 2 short-term trades, and that's it, right? So I don't think the rule really applies to most people unless you're just, you know, a junkie, right, or a monster that you're just trading really active. But I don't recommend, you know, I recommend with our new students maybe 1 or 2 trades 30 to 60 days from expiration, and 1 to 2 trades a week under 14 days or 15. Anyways, so here's an example that's been overall a successful strategy for 2015. Or no, what year are we? Did I just say 2015? I just went back 2 years. 2017, and this would be a 15-day butterfly. And again, is a 15-day butterfly the same as trading a 40 or 50-day butterfly? No, they're 2 different animals, right? So here's an example of the type of butterfly that we've been trading pretty successfully for the year. Overall, many more winners than losers, and pretty good. And I'll just talk about it a little bit. So here's an example I took when SPX was 26.27. Generally, I put these on Thursdays just because we had a trading group on Thursdays in Sheridan Mentoring, and that's when we put it on. But you could put it on any day you want, right? It could be about 15 days. But I'd put it on Thursdays, and I generally, because we've been in a low volatility environment most of the year, and I'll go the strikes. But let me answer one question, and you'll love my. You think my answer might be crazy, but I'm going to tell you anyways. This is my opinion, right? So please, you probably won't agree with me on this. So Ram had a question. He says, Dan, why are you doing the? Oh, you know, I made a mistake here. I'm sorry. This was the. I'm sorry. That's 17. That's all D's 15 expiration. Sorry about that typo. So this is the D's 15 expiration. You with me? Sorry about that. So anyways, so I'm selling 2 at the money. So it was a 26.27 at the time. There is no 26.27 strike. So I sold 2 26.30s. Buy my long strike 30 points down, 2,600. This is all calls. And then buy my upper strike 25 points up. And the goal is to get the deltas within 1 or 2 deltas of 0. That's pretty close to flat for me, right? And that's why we do this. Would be called an option terminology. This would be called a broken wing butterfly. Broken wing just means you have here's our risk on the downside. Here's our risk on the upside, right? So in a strategy like this, so this is the D's 15 expiration, just so we're all clear. It's the D's 15 expiration of 2017. You with me? D's 15 expiration, that's in 15 days of this year, 2017, right? So it's not the D17 expiration, it's the D's 15 expiration of 2017, okay? So the goal with short-term trades, I try to keep the deltas close to 0. And then you have a theta generally 10, 11 times more than your delta, so you have good time decay. The reason we do a broken wing butterfly is just because that's what's needed to get the deltas closer to 0. That's all. But when you do this, when you do a broken wing butterfly, right? with, in this case, 50% less risk on the upside than downside, which is typical of these broken wing butterflies, would this strategy be A, neutral to bullish, or B, neutral to bearish? A, neutral to bullish, or B, neutral to bearish? What would be your view? It'd be more neutral to bullish, right? Why? I got over $1,000 of risk on the downside. I got stinking $500 of risk on the upside. Which should be easier to manage? The upside. Why? I have less risk. So this is a typical configuration for a 15-day butterfly. Everybody see what I'm doing? And then I'll just kind of give the practical how this thing has done for the year. And with students, if there's any students from Sheridan Mentoring in here, if they want to, that have done this for most of the year, if they want to put in their comments, I'd be happy to have it. But here's the bottom line. So this is a positive theta. This would be called an income trade. It's a broken wing butterfly at the money, basically placing the short strike at the money. That will get your most decay. It's a negative gamma trade, so you get shorter deltas on the way up, longer on the way down, and positive theta, and it's short vega. But it's a short-term trade. In this type of trade, if you did this over the last year 50 times or whatever, and you put it on every Thursday, what would your experience be like, right? And anybody who's been doing this all year, please, I'd love your comments. But if you did this over the last year, I would say probably about, again, your cost for every one contract, just to spell it out here, your cost for every one contract would be about, somewhere around $1,000 or $1,100 bucks, right? So for every one contract, it'd be $1,000 or $1,100 bucks. So if you're trying to make 10% or close to that, 8 to 10%, you're looking to make 80 to 100 bucks on every one contract. Agree? So let me talk about this from a practical, how this has worked for the year, how it would have worked, and then I'll get into some questions. So the experience of this type of trade over 2017, it'd be probably about close to 60 to 70% of the time, somewhere in that range. For those students who have done this, let me know if yours similar experience, but I'd say 60% or 70% of the time, you didn't do anything. Dan, what do you mean you didn't do anything? You put it on. If I paid a 1085 debit, 60 to 70% of the time, on 1085, I'd be looking for, let's say, 8%. So I'd be looking at, a little over 100 bucks, right? So I'd pay 1085 and sell it out for near 12, right? And I'd say 60 or 70, or, depends, somewhere in there, depending, 6 to 10% profit. But I'd say 65% of the time, maybe 70, you put it on, you take it off, right? That's been the experience. The other 30 times, right? The other 30% of the time, you had to make an adjustment, right? You had to make an adjustment as it moved against you. But again, the key, the nice thing is for those of you who might consider yourself beginners, what I'm going to say next should encourage you, right? What I'm going to say next is, on this particular $1,000 trade, and that's just one contract. If you did 10 contracts, it'd be 10,000. But on one contract, I said you're trying to make 8 to 10%, which is, close to 100 bucks, right? But really, on the other side of the coin, if it goes against you, once you're down 100 bucks or so, or once the debit would get under 980, 985, you just get out, right? So, and that's the key to it. The key is keeping your losers about your winners and doing it every week. And that's tough for people. It is. What's tough is to be disciplined to do it, right? Most people in reality, they let their losers run, right? So that's been the experience, right? That of this type of trade. And let me just throw this out there. Overall, even in the last 3 months, with the market moving up 7% in the last 3 months, overall, this did pretty well. Why do you think, on the upside, why do you think this strategy did pretty well? What would be a reason, you think? Not that it didn't have some bumps, but why do you think overall this type of butterfly might have even done better than a longer duration butterfly in the last 3 months with the market moving up a couple hundred points in SPX? Do you have any reason why? Any reason why you think a 15-day broken wing butterfly might have done a little better over the last 3 months than a 50-day? I haven't seen the right answer yet, at least the answer I was looking for. Doesn't mean that some of your answers aren't right. It's just I was looking for something different. Philip hit it, right? You get out of it faster. In other words, if you had a 50-day butterfly on or a 60-day butterfly in this tsunami of 200-point up move and a low volatility over the last 3 months hit, even if you put different, maybe you scaled in and you're putting butterflies on every week, but they were 50, 60, 70 days out, was your boat in the water during most of this move? Yes or no? Were all of your boats in the water if you had 50, 60-day duration trades when this big move hit? Yeah. And having these short-term trades over the last 3 months, in my observation of doing them myself and seeing other students, one of the pluses has been you're like a special ops guy in the military. Dan, what do you mean by that? You're more nimble. You're more flexible. If this trade's typically on Thursday, the majority of the time, I'd be out by Friday or Monday. Well, if I'm out Friday or Monday, then that means even if I'm out Monday morning, I don't have anything on Monday afternoon, nothing on Tuesday, nothing on Wednesday, nothing till Thursday afternoon. That means for 3 days, if the market goes up 4,700,332 points, I'm out. So because I'm only in the trade 2 or 3 days, as the market's going up, like a special ops soldier, I'm in for a day or two, out for 3 days. Then if the market goes up, I'm repositioning a new butterfly at a different price. Does that make sense a little bit? So am I saying 15-day butterflies are better than 50-day? I'm not saying that. But what I'm saying is my observations with myself and students over the last 3 months, as these strategies have been a little more flexible and have worked, had some good success, even maybe a little more than some of these longer term. And I don't think it's the volatility, right? That may play a little part, but the point is these trades, you're in and out quicker, so you're not exposed all the time. If you're in a 60-day trade, when the hurricane hits, you have more boats in the middle of the ocean than these 15 days. Does that make sense? Anybody have any comments on that? So that's been my observation. Those are just some comments, just trying to give you some general thoughts on the 15-day. Petra says the bid-ask are very wide. They're not. I'm not sure what are you talking about, like SPX? No, most of the time I would say 95% of the time, because I traded this probably every Thursday for the last 7 months. So I would say 90% of the time I'm filled pretty much near the midpoint. Now, am I disagreeing that there's a wide bid-ask spread? I'm not disagreeing with you, right? In other words, the bid-ask spread on a butterfly is wide, but that has nothing to do with where it's trading at. You agree? In other words, if I go to my car dealer down the street, is the list price on the car, if I just go in the parking lot and say, boy, look at the list price. Now, if I go into the car lot, and especially on a used car, will what I pay be different than the list price? Yeah, right? But if you trade it, can you get near the mid-range pretty good? Yes. A question says, Don says, here's a question. Is there any advantage to splitting the risk capital across both Friday and Wednesday expirations? I don't think so. To be honest with you, I still like Friday expirations better. But I don't think, I like to diversify the capital and not put all the trades on the same day, but I try to get more Friday expirations. Chris, another question says, are calls better than puts with a 15-day duration? The answer is no. You could do 3 different types of a 15-day SPX Butterfly. You could do all calls, the 2600, 2630, 2655 calls. If you like puts better, you could do the 2600, 2630, 2655 puts, right? If you like credit spreads and iron condors better, you can do an iron butterfly, right? You could buy the 2655 calls and sell the 2630 calls, and then you could sell the 2630 puts and buy the 2600 puts. So there's 3 different ways you can do this. Which is better? Neither. Why do I do calls? I'm just used to doing calls. It's easier for me to click on the brokerage firm and do calls. But, if you've done credit spreads or iron condors, maybe you're more used to that. All right, let's move on. Now, here's a different experience, right? Here's a similar butterfly. Let me just say, so my width, I would call this a 30-25 broken wing butterfly. So the width from my short call to my lower strike long call was 30, and the width from my short call to my upper strike long call is 25. So you're going to be narrower on your widths on a 15-day trade. If we go to a 44-day trade, you see my widths are a little different. Now, I still have a broken wing butterfly, less risk on the upside, more risk on the downside, typical of a successful butterfly over the last year or two because the market's been going up, and you structure them with less risk on the upside than downside. But this has been a successful butterfly. This is more of an out-of-the-money broken wing butterfly. So here, we were 26.29 earlier in the day, and it set a butterfly at the 26.10 strike, out of the money, right? And selling 2 44-day, that's Jan 12, 26.10 puts, and these had a delta somewhere typically in these types of trades around 40 for the short put. I bought the 26.45 put and the 25.60 put. So this was all puts. The previous example was all calls. The previous example was at the money. This example is out of the money. My short puts are approximately 19 points, 19, 20 points out of the money on the put side. And the width here from my short put to my highest strike long put is 10, 20, 30, 40, let's see, 35 on the upside, and on the downside, 50. So this is an out-of-the-money put broken wing butterfly, right? And if you look at the Greeks, again, our deltas are pretty close to 0. We have positive theta, but it's only like 4 or 5 times bigger than the delta versus 10 to 15 times theta is bigger than the delta in a short-term trade. But this is normal on a 44-day trade because you're longer out, right? This is your expiration graph, This is your T plus 0 graph. It's going to be a little smoother on a shorter term trade, but you're going to be in the trade a lot longer, right? The debit here is $3.30 debit, but your risk, you can see, is almost 2,000. So you can see over the last year or two, this has been very conducive to the upside because you're starting to trade with substantially less upside risk than downside. So just one adjustment on the upside eliminates the risk. So in our community, we would call this an all put flat fly, but it's just a out of the money put broken wing butterfly. So it's an example of a butterfly that's starting out close to delta neutral, but because of the trendiness in the market, it's worked wonderful over the last year or two, right? It's just simply an out of the money put broken wing butterfly, but they've worked real well with little or no effort. Why? Well, you can see there's, 10 times less risk on the upside than the downside. So you could see with this for the risk on the downside, this the risk on the upside, it's going to be tough to get in much trouble on the upside. Do you agree? It's really tough to get in much trouble on the upside. So that's a 44-day SPX butterfly, and I think most of the last year, it's worked really well. I think the troublesome part for this butterfly has been September and October because you had 9 or 10 VIX, and you had the market just go up a couple hundred points. So it was tough to grind out some money because you were in the market the whole time. You agree? And not that there wasn't, if you adjusted on time, I think you could keep your losses under control on the upside, but you didn't get any relief, right? Because even if you put on a 44-day butterfly every week or every 2 weeks, all your ships were in the water during most of that 50-point move. So I honestly think, I've seen in our community and in my own trading, 15-day butterflies worked much better than these longer term over the last 3 months with that 7% move in the SPX. And as Robert said, there's just two ways to set these butterflies up that we've been trading them, either at the money or out of the money. Some people like them out of the money. Even though the strikes are out of the money, this is the focus. The deltas are near zero. So it doesn't matter to me whether I'm starting with my short strike at the money or out of the money. I prefer at the money than out of the money butterflies because then I'm more in the range of where it is and I have a better chance of getting out of the trade quicker. Gary says, if there's a down move, would the negative vega be a problem? If Sylvester Stallone would say, yeah. But it's just that in most of these broken wing butterflies over the last year or two, has there been many downside problems? No. It's like being in Miami Beach and having 70-degree weather every day for a year or two, and no rain or anything. But yes, negative vega would be a big problem, right? If we start going down a lot. So overall, this trade, I think people in our community on the 44-day SPX butterfly, people who have been consistent with this, I think, and you guys could correct me if I'm wrong, again, for yields for the last year, I think this has been a little rougher. Last year was better, but I think for the guys who are sticking with the risk management the right way and doing it every week, yields probably in the 20 to 30% for the year on this for people that kept any losers from getting too crazy, right? I think that's a pretty fair 20 to 30%, whereas I think the 15-day butterfly would be closer to 50 to 80% because you're going to make a much higher yield. I think the shorter term butterfly worked much better. And again, you're able to put many more trades on per month. So those I think, are realistic discussions on those two strategies. Anybody agree or disagree, or give some comments on their experiences with these types of butterflies over the last year? All right. Len, you take care on your radiation treatment. Our thoughts are with you. Thoughts and prayers. I hope you're okay. Nick says, what do you do if your broker requires more margin than the maximum loss? Do you set it up as a credit trade using both calls and puts? Okay. Now, interesting. I'm going to give you my comments. You ready for this? My Chicago answer, Nick. So Nick says, what do you do if your broker requires you to put up more capital, right, than the position has? So here's my answer. Leave that brokerage firm. How do you like that? Right? Find a new stinking broker. If they're going to charge you more capital than the risk, if I have $1,000 of risk on a trade, if the world collapses, and my broker, they're not all the same, is going to charge me more. And I'm not saying you should just get up and leave, but I'm just saying you're good brokers out there, right? You're good brokers out there. Your Thinkorswim, TD Ameritrade, your Tastyworks, your Trade King, which is Ally Invest. Some of these, in most of these cases, I'd be shocked if they're charging you more, right? E-Trade, again, E-Trade is again, I'm not saying good or bad. I haven't traded E-Trade, but E-Trade's been around a long time. And I'm sure they're good. But the point is, they don't all charge the margins the same. Do you agree? I think there's about 80% they do, but on certain strategies, they may charge you differently. And I think you have to be aware of that. All right, well, last quick strategy, and here's been a good iron condor alternative over the last 3-4 months. Personally, I think this strategy has worked better than any of them over the last 3-4 months. Again, it's the same foundation of an iron condor. So today the example was with us at 26.30 selling an out-of-the-money call and an out-of-the-money put. That's called a short strangle, which is the same foundation of an iron condor. But like an iron condor, instead of buying my long hedges in the same expiration, a double calendar is buying my hedges in a further out expiration, the same strike. And that's called a double calendar. So typical setup, and again, you could do a longer term one. I've done more of a shorter term one. Here's a 30 by 15 day example. And I think these have worked very effectively in the last 3 to 4 months. So in this example, again, you could put them on. I was putting these on every Tuesday or Thursday. And in this example for a 15 day, so my shorts are 15 days and my longs are 30 days out. I'm setting my call calendar. I do a call calendar 30 points up from the current price. I do my put calendar about 30 points down. I want to get my deltas near zero. Again, on a short-term trade, 15-day trade, my theta is going to be 10 or 15 times bigger than my delta. And you could see, like an iron condor, you have room here. Between your short strikes, you have some room here. This particular example would be about $11.90. So for every one contract, it'd be almost $1,200. And I'm trying to make about 10% on each one contract. And you kind of manage it between the short strikes. Is kind of, as long as it's between the short strikes, you have a smile and things are well, right? So anyway, and then finishing up here, game plan for 2018, keys to successful strategies. I think the vehicles are important. I like SPX and RUT. I like SPX a little more than RUT, but I think RUT's fine. Nothing wrong with SPY or IWM. I just like SPX and RUT. They're good, well-diversified vehicles. Russell's made up of 500 stocks, 2,000 stocks, SPX 500. But there's nothing wrong with using some good liquid stocks over $100, right? That trade a lot, as long as you stay away from earnings, Amazon's and your Netflix. But I like SPX and RUT better. Strategies, how many? I think you take 2 or 3 strategies. I use mainly different types of butterflies, different types of calendars or double diagonals for like a long Vega trade, some iron condors. You know, I haven't done many iron condors this year because the volatilities were pretty cheap. And then I think it's important, do you have a plan? You know, do I think people should be trading if they don't have a decent plan? No, I don't. 4-step risk management plan. On every trade I do or teach, we start out with, okay, what's the proper setup, right? What's the proper setup? How should you set the trade up? How should you set the butterfly up with the VIX at 9 and the market at all-time highs? Or how should you set up a butterfly or an iron condor with the VIX at 17 and the SPX 300 points lower? So even though we trade a butterfly or an iron condor or a calendar every single week, right? Do we always trade it the same? No, we may give little tweaks based on the price levels of the market, number 1, based on the volatility levels of the market, number 2, number 3, based on the speed of the market. And then number 2, for every trade, you want to have a profit target and max loss. What are you trying to make? And what's your max loss? Number 3, it might be when you adjust, and then number 4, how you adjust. But you have to have a plan. You don't stink and wing it, all right? Next, directional trading. I would always keep that in a separate allocation. You know, if you're trading 10 grand and you want to put 1,000 or 2,000 in directional trading, keep it separate. Diversify it from your income trading like I'm talking about, so you can keep an eye on how you're doing on your directional trading. I think it's difficult to pick the direction of the market every week or month, and that's why I prefer this type of trading based on probabilities and decay. I don't see anything wrong with picking direction on, hey, I like Apple over the next year or 2, and I'm going to sell cash secured puts. That's how I would use directional stuff. But, you know, I think I would be doing both types of trading. Diversification is key. We diversify our trades according to, we don't put them on different days. We diversify the duration of the trades. We diversify the types of trades, some long Vega, some short Vega. But the key is do a few trades, but you're doing them every week. To become a good craftsman, you have to trade a lot, but you have to trade the right way with a good, sound plan. And one thing I would just say is we had a good special Thanksgiving special, 20% off our online classes during the holidays. And we have our once annual mentoring special that will be coming up in a couple weeks. Some information will be coming out about that, and hope you take advantage of that. So folks, thanks for today. If I can help you, if you have any questions, you can email me, dan@SheridanMentoring.com. All right, well, thanks everybody. Thanks for today, and we will see you later. Thanks.